In this video, I'm going to reveal the absolute truth about Forex brokers. It's unfortunate that no one talks about the things that you're going to learn about Forex brokers in this video, but you're a lot better informed because you know this stuff. Roll the intro. Hello and welcome to the Pine Street Capital YouTube channel where we talk trading and investing. My name is Ron and I am the managing partner of Pine Street Capital. I've been trading for over 6 years and today we are going to be talking about Forex brokers. Most of the content that you find online about Forex brokers will essentially be content about how you select Forex brokers, right? They'll tell you the usual thing, which is make sure you're trading with a broker who's regulated. Make sure that your broker has low spreads and commissions. Make sure your broker provides quick withdrawals and deposits. But that's only the surface level of what you actually need to know about your broker. Most of what we're going to be talking about today is whether or not your broker has an incentive for you to lose money. In order to effectively evaluate this, you need to understand the infrastructure of the Forex market. And you need to understand especially the liquidity food chain. Traders usually get their liquidity from retail brokers, right? So you are connected to the market via your broker, right? And then your broker is connected to the market through what's usually called a prime of prime provider or an aggregator, right? So that's where your broker gets their liquidity from. And that prime of prime will usually get their liquidity from either a tier 1 or tier 2 investment bank, right? And these banks then get their liquidity from each other. So that's essentially the liquidity food chain of the Forex market. Most traders believe that when they place a buy order on Euro USD, that order goes directly into the market. And this could not be further from the truth, right? And what actually happens to your order depends on whether your broker is an A-book broker or a B-book broker. Now, I know what you're asking. Ron, what the hell is an A-book broker? What's a B-book broker? So an A-book broker is a broker whereby when you place a buy order on Euro USD, that broker then sends your order over to a liquidity provider. And that liquidity provider fills your order. And a B-book broker is a broker whereby if you place a buy order on Euro USD, that order is internalized by the broker. In other words, the broker fills that trade. So with a B-book broker, essentially what would happen is when you place a buy order on Euro USD and your broker fills it, and then you then place a sell order when you're getting out of the position, your order is filled by that broker again. That means if you've made a gain on that trade, then your broker is on the opposite side of it. Therefore, if you make money, your broker loses money. So given that you now know about B-book brokers, you start to ask questions like, if your broker makes money when you lose money, then is that broker really trading on your side? Does that broker have your best interests at heart? Let's dig deeper into that. You may be asking yourself, is it even legal for a broker to B-book? And the simple answer to that question is yes. But in most cases, your broker actually needs a special type of license in order to B-book. You may be familiar with the ODP license that brokers who B-book are required to have in South Africa. The FCA in the UK also has a special license that the brokers need to hold in order to B-book. Australian regulator also has those, as well as CISEC. So these are essentially the top tier regulators within the financial markets, right? And they usually require brokers to have a special type of license in order to B-book. Next question is, why would a broker want to B-book, right? And brokers would want to B-book because of a simple concept that was introduced, well, that was brought to light of the retail trading space a few years ago. And that's the whole 90-90-90 principle, which is that 90% of retail traders lose 90% of their money within 90 days. So if you are a broker and you know that this client who's just signed up with you is likely to lose everything in their account, well, 90% of what's in their account in 90 days, then one of the most profitable actions, rather than taking a piece of the transaction, might actually be to bet against that trader. Almost running a casino of sorts. A casino makes money when you lose money, right? So kind of the same concept with B-book brokers. But with B-book brokers in particular, there are different types of business models that a B-book broker can run, right? And the first one is whereby they're running a complete bucket shop. And a complete bucket shop is what I've just explained. That's the casino whereby, you know, when you lose money, the broker makes money, and vice versa, right? Then there's the kind of B-book that most brokers run, which is also called the hybrid model, right? So within the hybrid model, the broker runs both an A-book and a B-book, right? So the broker internalizes some of the trades, and they send some of the trades over to a liquidity provider. How do they decide which trades they're going to send to a liquidity provider versus which trades they're going to send to, well, which trades they're going to internalize? They essentially do this by studying your trading patterns, and they've got a lot of data on this because most brokers you'll find have over 100,000, sometimes millions of clients. So they know the characteristics of people who are actually profitable in the markets. So the most profitable way to deal with clients who win versus clients who lose is by putting clients who lose money into the B book, and then clients who make money, putting them into the A book, right? So by having a client who loses money in the B book, they're obviously going to lose money over time. So you then internalize those trades and essentially make money from those trades when those traders lose money, right? And that's essentially called an OTC gain within the brokerage world. That's how you take in revenue from the B-book clients, right? Then as for the A-book clients, you're passing their orders on to a liquidity provider. Now that liquidity provider charges you a certain amount in order to give you access to that liquidity. So essentially what you do with A-book traders is you then add a markup or a commission on top of what your liquidity provider's charging you, right? So those are the two ways that brokers make money. They make money from spreads and commissions and from OTC gains, right? And that is the average broker. The average broker that you find, the most popular brokers that you find, and the brokers that most traders trade with are actually running what's called a hybrid model. Now, the next question we need to ask ourselves is whether or not the hybrid model is actually ethical. And to do this, we're gonna break down sort of the pros and cons of an A book versus the pros and cons of a B book. So let's start with the pros of an A book / cons of a B book. Number one, you know that your broker isn't trading against you, right? Your broker doesn't have that conflict of interest whereby they actually hope that you lose, right? So that's the first benefit of trading on an A book, and the downside of having your broker B book you, right? And the second benefit of having an A book broker who isn't on the other side of your trade is that what you find is during times liquidity is high, and because there's high liquidity, there are lower spreads which are then passed on to you from your broker, right? So those are the benefits of trading with an A-book broker / being on a broker's A-book, right? And you can also call those the cons of the B-book, right? Now, let's talk about the cons of an A-book / pros of a B-book. The first con of an A-book is that there is still someone taking the other side of your trade, whether it's your broker or your broker's liquidity provider that's taking the other side of your trade. The result is still the same. A losing trader is still a losing trader, whether they're A-booked or B-booked. And the second con of trading on an A-book is that during times of high market volatility, liquidity is nowhere to be found, right? So think of trading during say the non-farm payroll release. What usually happens is a lot of the liquidity within an A-book completely disappears, and you usually don't get the same instant fills that you would trading with a B-book broker. The other downside to trading with an A-book broker is 9 times out of 10 you actually really need a lot of money, and I'm talking hundreds of thousands to millions of dollars in a trading account, right? And the other downside to trading with an A-book broker is you don't get as high leverage as you otherwise would have if you're trading with a B-book broker. Because A-book brokers know that there's a lot of credit risk involved with providing high leverage to traders. So if you're trading with an A-book broker, you need to be willing to put up millions of dollars, and you need to be prepared to take on lower leverage within your trading. And if you have some kind of a news trading strategy that worked within a B-book and you now want to switch over to an A-book, I can almost guarantee you that winning strategy is going to turn into a losing strategy because you don't get instant fills anymore. This information is a complete game changer for a lot of traders because you get a lot of perspective of why certain things happen in the industry and why things are the way they are, why 90% of traders lose money. One thing that comes right off the top of my head is the fact that what you'll find is a lot of the marketing material that the retail brokers put out there is more geared towards the trader who's just starting out or people who don't know much about trading, right? And it's all about getting them to start rather than looking for traders who already trade and trade profitably, right? Because a trader who loses money in some cases for brokers who are running a B-book may be a lot more profitable than a trader who's continuously making thousands of dollars every single day, and you can only make money from commissions from such a trader. Whereas on the B-book you can make the OTC gain, which in some cases can be a lot more lucrative, right? So that's the first thing that it opens your eyes to. And the other thing it opens your eyes to is the fact that some brokers actually use words like ECN or STP to sort of mislead traders into thinking that we trade on your side and things like that. They tell you within our ECN account, within our STP account, your order is taken straight through to our liquidity provider, but this isn't actually the case most of the time. Most of the time within that STP account, the liquidity provider that your trade is actually sent to is either another one of the company's entities, or sometimes it may be a prime of prime provider who then does sort of a profit share with the broker, right? So it's important to keep things like this in mind. Another thing that's important to mention is the ECN account. Within the ECN account, they sometimes also do the same thing, which is they send your order over into an ECN, and the other participants within that ECN are entities owned by the broker, right? And the best way to know whether your broker is an A book broker or a B book broker is through what's called the RTS 28 report, which brokers in Europe, unfortunately with other jurisdictions, it's not a requirement for brokers to disclose the execution venues whereby your trade actually goes to, right? So within the RTS 28 report, it shows you what percentage of your broker's orders went to different liquidity providers, and you actually see what liquidity provider, the percentage of your broker's orders that were filled by that particular liquidity provider. So that's a very useful report in sort of gauging where your broker stands in terms of A book versus B book. But another thing to keep in mind whilst looking at the RTS 28 reports is that sometimes the broker will actually own the execution venue whereby the order is going. So that's one great thing I like about brokers that are regulated in Europe, in particular the CISEC regulated brokers. Even though some people may see Cyprus as one of those jurisdictions that doesn't regulate brokers very well, it's actually a very good jurisdiction for your broker to be regulated in. And the other thing that it opens your eyes to, knowing about the A book and B book broker, is retail traders would not have the access to markets at such a cheap cost if it wasn't for B book brokers, right? So on to the final conclusion of this argument, which is it bad for a broker to be a B book broker, and is it good for an A book broker to conduct business the way they do? And it's not as clear cut as you probably think it is. You know, if you're a profitable trader, right, then what's going to happen is, say you go into your average brokerage that's running a hybrid model, right? They run both an A book and a B book. When you get into that brokerage, they're probably going to assume that you're just like the average person who comes in there, and the average trader is a loser, right? So you're probably going to be trading on the B book. And as you trade more and more and more and more, as a profitable trader, they start to see some of those characteristics. And all this is done by algorithms, by the way. There's no one sitting in a dark room checking whether Ron has made a long or a short position on euro dollar. It's all done by algorithms. So essentially, this algorithm will look at your trading patterns. They'll look at your trade results over a good enough sample size, and they'll determine whether or not you're a profitable trader and whether or not it's more profitable to keep you in that B book or to send you over to the A book. So that's what they call profiling clients, right? So when they profile you and they see that it's more profitable to have you in the A book rather than the B book, most profitable traders will usually end up in the A book, right? And losing traders will probably, majority losing traders will be in the B book. But sometimes what you'll find is there are quite a few profitable traders within the B book. So it's not as clear cut as profitable traders going to the A book and then unprofitable traders going to the B book. No, it's usually an algorithm that tries to optimize the revenue of the broker, right? But one thing I will say is that if you are a losing trader, you're probably going to end up in the B book. And is that a bad thing? I don't think it is a bad thing. I think the B book actually provides superior liquidity, particularly if you're talking about times whereby volatility in the markets completely increases and things like that. And because you're in the B book doesn't mean the broker is going to manipulate market conditions with things like that. I mean, it's almost impossible for the broker to manipulate the underlying market. I mean, it's the FX market. It's a market that trades $5 trillion a day. So what are the chances that a broker with even a balance sheet of $1 billion, maybe a few $1 billion, can move the market even 1 or 2 pips within a major currency pair like the euro dollar. So I wouldn't worry too much about being on a B-book. It's actually an advantage in many ways, right? And if you're trading on the A book of a brokerage, right, then it doesn't necessarily mean that you have any better trading conditions than someone who's on a B book, right? So at the end of the day, as long as you're getting good trading conditions from your broker and there are no fictitious spikes or anything like that that appear on your broker's charts, then you should be fine. But it is very important to be aware of the fact that there are A-book brokers and there are B-book brokers, and particularly with B-book brokers, there's some of these small brokerages that are not regulated at all that will essentially run bucket shops and actually put in fictitious price spikes and things like that in order to make you lose money. But as long as you're aware of the fact that that a broker may or may not be incentivized to make you lose money, is a very good starting place. I definitely hope you learned something from this sort of mini rant of mine. I tried this video with a lot less structure than I usually do. With that said, if you like this content, hit the like button below, and if you'd like to see more like it, subscribe to the Pine Street Capital YouTube channel and join our trading community on Telegram by using the link in the description. First link, by the way, first link in the description. With that said, I'll see you in the next video. Take care.